Today, folks, we're doing a deep dive look into my all-time high $314,000 dividend stock portfolio. Then we're going to take a look at some of the most admirable growth, high conviction plays held by the largest YouTubers like Jeremy from Financial Education, which a lot of you guys in our personal WhatsApp chat group are actually holding these companies, and they are all down across the board. Tattoo Chef, Corsair Gaming, Wish, they're SoFi. We're going to take a look at all of these today. So in the clarity of my transparency, smash that like button, folks, and let's kick this off by first of all taking a look at my tax-free savings account, my largest account, hitting all-time highs today. And as many of you know, I'm running a short-term experiment on a DRIP, a dividend reinvestment plan for Bank of Nova Scotia and Northland Power, because I recently discovered that if you set these DRIPs up, you actually get a discount against the current stock price. And apparently on Bank of Nova Scotia, that's a 5% discount. And if this is true, this is going to change the entire way I look at reinvesting my dividends. Some of you recommended that Algonquin Power also does this. I just missed it or overlooked it. And if you know any others, let me know, because these are a rarity. But what's keeping the portfolio up? And it is the path of least resistance to wealth. One of the reasons that I have not been buying some of these smaller caps, because they're much more volatile than these large caps when you're talking about Microsoft and Apple. I mean, Microsoft is almost at $300 a share, guys. I am up massively on this position with no intention to sell a single share. I am getting a little slaughtered on my most recent purchase, being MPW, the Medical Property Trust REIT. I am going to be cost averaging in slightly more at these levels with dividends that I do get in, but that is the TFSA and some of the higher performers. When we're talking about my managed account, not much going on in here, guys. I don't play around with this. I have been withdrawing the dividends, and actually the first time I've been spending dividends on like physical things in the real world, and the first time in my investing career, because this is just a regular brokerage account. I got to pay tax in here. Everything's kind of just nominal today. I know it looks like my banks are starting to trade down, but keep in mind, I bought these banks at the bottom of that crash in 2020. And when I transferred them from my other account, they ended up not transferring over the stock prices that I paid. I don't know why. I've tried changing them in the quick menu, but it doesn't actually work for some reason, and I've been too lazy to call the broker. But that's where this account sits. Currently also just holding nominally flat at around 50,000. My RRSP, I'm getting slaughtered on. The big mistake I made in here was presuming that Clorox was going to post better numbers than they did, and I got hit hard. I'm down about 9%. If I was smart, I should have just put it in an index fund. This is a long time retirement account, and I only hold 3 positions. So unfortunately, to my own stupidity, if I was smart, should have bought S&P 500 index or the QQQ ETF. I may consider coming back to that decision if this rolls back around, because in a long-term account, it kind of seems a little frivolous to only hold 3 stocks. Finally, my corporate trading account. This is the beauty, the gem of my future, where I run capital in a disconnected third party from my own personal name. I'd probably only make sense to people that are incorporated. But anyways, in here, folks, Algonquin Power is doing pretty good. It has been pulling back this week based on its earnings, but its earnings were actually nominal. They were fine in my opinion. One of the reasons I love utilities, because they're not as volatile. We got Tesla holding up here at its nominal range, sitting around $716 a share. Google, Facebook, again, being nominal. Things have been flatlining over the last week, but I'm by no means complaining, because I am up 8% on my US holdings and still up 2% on my Algonquin Power. So everything in this account is green. You might see a little red, but that is based off when I bought these US stocks. I love the way Royal Bank at least calculates in the currency exchange. It's something no one does with their portfolio, because if they did, you'd realize that your entire US holdings convert to USD, and the USD is down 10% in a year. So just keep that in mind. Most people don't even imagine their stocks go down without their stocks going down, but they do. So that is where my 314K portfolio sits. I have purchased some more Bitcoin over the week. I am now sitting at my 1/10 position of a Bitcoin. I've now made it 2% of my portfolio. I know many of you might not be Bitcoin fans, but I have been enjoying cost averaging in at those lower suppressed prices, starting to see a rally back. But putting my portfolio aside, let's talk about the stocks and other people's portfolios, kicking it off with the Corsair Gaming. Now, in the pandemic, there was nothing better than watching the rapid expansion of video game players, but based on this week, trading down 4%, guys, after the earnings post, was it justified for the drop? In my opinion, no, and I want to show you some of the concerns people have. Net revenue was up 24.3%. Gross profits were up 24.1%. So why are people concerned? Well, their adjusted EBITDA margin was down 10.9%. And unfortunately, their EBITDA only increased 4% year over year. And that might be confusing to some of you non-technical investors, but these aren't the kind of EPS numbers people want to see. And the EPS is after all the expenses and everything. But honestly, the only thing I care about really is the net revenue and the profit margins. This company has phenomenal profit margins, so we can presume some of the expenditures they're running into on this earlier quarter probably won't persist into the future. Thus, a lot of investors have recognized that and why the stock actually isn't trading down that much, might even be presenting a setup for a discounted buy. Tattooed Chef, however, getting slaughtered. I don't like this company because of the low margin rate on their products. And I think because of these earnings, people are kind of hinting why they don't want to be in it. But just taking a look, guys, the revenue was up 45%, phenomenal. The gross profit was up 15.7%, guys. And I just think it's incredible to see these companies able to grow these revenues from this time last year at this expanded rate. Absolutely phenomenal. But like I mentioned, the reason these companies get destroyed is their net EBITDA was just terrible. I mean, it was negative 5.9 million compared to this time last year. And people don't like that, even though the numbers were up massively on revenue. Gross profit has actually been increasing slightly. But like I said, when I'm looking for gross profit margins, I like companies that can scale to at least a 20 or 30% rate. I mean, when you look at Apple's 30% gross margin, it really reflects on the massive EPS numbers. And again, gross margin, guys, they only have a 15% leeway in the revenue to actually post positive EBITDA. So that kind of gives them a little bit more of a slim line to pull those numbers off. Let's talk about Wish. Wish is one that I would be a lot more concerned about, guys. This one has a lot more red flags going on with it. Thus, we can see represented being down 24% over the last 5 days. So why? Well, two big red flags. First one, total assets have been decreasing rapidly. I think their total assets are almost down by what, $700 million over this year prior. And unfortunately, their current liabilities haven't decreased nearly at the same rate. So they are exponentially losing their underlying asset value in the current market, which is kind of scary. And the other big red flag is the cost of revenue, guys. When you take a look at total revenue, it has not only declined from this time last year, at least on the 6-month end, it has gone up slightly. But the big concern is if you look at the 6-month end on cost on revenue, it has doubled from this time last year, but their actual revenue hasn't doubled. So their strategy behind spending money is becoming less and less strategic. I've posted that they are lowering guidance, which is something to be slightly concerned about, but I would keep an eye on this because if this persists quarter over quarter, it is going to continue to hinder the stock price. Let's talk about SoFi. This one's been hit 12%. Very similar to Coursera. I think this is setting up for perhaps a discounted buy in the market because when we take a look, guys, they are still expected to grow at a healthy rate. They posted phenomenal numbers. If we scroll down, what I really want to show you is buried down in here somewhere when it comes to their actual net revenue. And this is a really weird setup, so let me pull my head out of the way here. But if you take a look at the year for 2021, Q2 2021, their net revenue was 17 million, which is double from Q1 and is literally like quadruple from what it was the years prior. So this company is setting up nicely. They did end up seeing a lower guidance from analysts, but apparently if they keep on this track, they'll probably still beat their guidance expectations. But this is one that I think is just having a cyclical bump in this kind of midterm year. But these are companies, guys, that a lot of big YouTubers are fascinated by. A lot of people in our chat groups hold these, and I hear about them all the time. But I, in this current market, really like large caps, path of least resistance to me right now. And if I find some small caps that I'm interested in, I'll always keep you guys in touch. But let me know what you think about these, especially if you're holding them, in that comment section below. In light of this, stay cool, stay awesome, and I look forward to catching you tomorrow.